Hi, Sean Haynes of the Ag Center and Agri CFO, kind of giving you a weekly update in California agriculture. Just want to say thanks again for watching and listening. If you aren't looking at my face, thank God. And really appreciate the feedback. Appreciate all you folks click on stuff, give me kind of some pointers on what you'd like to hear about more. If you can, share this thing, send it out there to kind of get it broadened out so I can reach as many people as possible, and also kind of get feedback as much as possible, which I really like to have. Just really want to kind of continue to educate people what's going on in the markets on a day-to-day basis if I can, and give you my thoughts on it for what they're worth. So again, thanks for supporting us, and let's get into dairy markets here in California this week. Dairy markets continue to firm up a little bit. Prices are down a little in the upfront months. Look at about $17.50 for August milk paid in September, but that's still about $2.50 higher than the prior month. And then with kind of recovering feed prices, we should be getting a little bit of relief here pretty soon. After August, September, October, November, you're looking at $18.50 up to $18.90 per hundredweight on the blend price here in California. Just these spot loads for cream back east to really kind of decrease the amount of excess milk available, which is allowed to hold prices up. Cheese prices have been under pressure to move up as well. They're moving pretty well ahead of the holiday season. Butter inventories, again, guys are kind of getting ahead of that of the holiday season. There's also a little bit of scarcity, sounds like, for cream. We haven't seen any actual reports yet on actual production per cow and cow numbers. That won't come out till later this week for July, but I'm expecting quite a big drop in maybe production per cow and maybe even cow numbers as far as this herd goes in July, in response to low milk prices with these high beef prices on the backside. These cull prices for dairy cattle kind of shot up again last week. We're looking at $1.10 to $1.23 for good quality, good yielding Holstein cows. You know, the calf markets remaining strong. These drop calves, the beef on dairy crosses are up $6.30, $6.15 per head. Holstein bull calves around $3.50 per head as well. Feed costs still continue to slope off a little bit. You know, you've got test hay down below the $300 mark on a consistent basis, down the $290, $285 range. You got wheat and cereal hays down below $100, in some cases even from $90 to $120. Guys just can't seem to get rid of it. And then we've also got hull prices down to 105 up in the north market, all the way, and then down the south market about 125 for almond hulls, which is less than half of what they were last year. So I think as these feed costs continue again to reset in February, like I've been talking, we've got this kind of reduction in milk flow coming from this culling and the heat that we've experienced across the United States so far. And then also with these higher calf prices that you guys are experiencing, we should see a recovery in the last quarter of this year where most guys are back to profitability again. If you're not in profitability about that point in time, I'm not quite sure what to talk to you about on the dairy side. You've got to be kind of producing milk at the 1850 range, I think, in the last part of the quarter to be sustainable long range. So it's something to you guys to think about as the target goes. And then also long range for next year looks good if all those scenarios happen, especially since we've got kind of this heifer hole, it looks like. I haven't been able to verify that, but at least the numbers I look like just don't show enough heifers that kind of replace cattle and chase after this excess production, get an excess production scenario to chase price if that happened next year. So that's what we've got on the brightening side of dairy here in California. Let's get into California beef markets. Beef prices came off about 3 cents to 4 cents per pound. They've been holding on the calf side. They're just on the availability of animals, and there's a lot of holes looking forward in these feedlots. And I think guys are starting to worry about the ability to keep them filled come next year and possibly consolidating into those feedlots. So I think there's kind of this rush to get animals. It's been keeping the beef on dairy cross calves high here at the 615 to 630 range, Holstein bull calves high at the 325 range. And then cash prices for these animals at $275 for heifers, $3 for steers in the beef and dairy cross side in the 450 weight range, and it's still holding the 250 range on these heavier cattle at the 7-8 weights. So markets continue to be strong for these cattle, a lot of demand. There was some worry for a while on the consumer side that there wasn't going to be any pricing from them as demand kind of sloped off in face of pricing, but it looks like these box beef prices have popped up a good 13 cents. They're at $360 and $288 for choice and select this week, respectively. And then it's the feed yards that are kind of giving these finished cattle over the processors have given up some of their profit a little bit. They were looking pretty good, making $300 to $400 per head. They've kind of sloped off some of that pricing to get them into the processor. Still profitable, but it's allowed the processor to have some profit on the processing side, and so it's kind of gotten that logjam moved out. Feed costs as well seem to be coming off in general from last year. So again, these roughages have been coming off and not a lot of demand. Is the dairy sector is really eating hand to mouth and not taking them as fast as they usually do. That's providing availability to these folks in these feedlot side. And then also just looking at surveys and looking at some initial numbers, we're just not seeing the rebuilding that you'd expect with these high prices because of lack of grass and availability back east on these native cattle. Still 35 to 40% of the ground back there is kind of in some kind of drought situation that cattle are fed on. And these guys, with these high prices for cattle and some tight availability of grass, they really just aren't retaining heifers to kind of to rebuild this herd. They're letting them go. We have seen some slope off on the culling side, which means they're getting rid of cows less rapidly. That might be just because they've cleaned out all the old cows. But I think for the time being, for most people in the consensus, it looks like we have a tight cattle market into 24 and in 25 now. Because of that, so prices should stay pretty good. As high as they are now, I don't know, but they've come down quite a bit. Pears out here doing pretty well. They're $1,700 to $2,600 a head. They're about $300 or $400 off their peak, but still strong. Unless you go to some of these crazy sales where, you're seeing some things going for $3,500 a head for a pen lot of these animals. It's kind of crazy. You wonder if they're going to pencil out. But if you look at these calf prices right now, and the fact that you got 2 or 3 years of good cycle coming on them, you might actually make your money back at that price, which is kind of crazy. All of this is also pulling up the cull cow market on the dairy side. You're looking at $1.10 to $1.23 for good quality Holstein cows coming out. It's up about 20 cents over the past couple of weeks. So if you look at all these indicators, it looks like things continue to push up. Looks like they're going to continue to stay profitable. And even with these cattle that were placed in March being marketed this year, break even's only like $1.67 if you take some average costs. And even with these higher beef prices and taking off some lower feed costs, you're still looking at $1.97 for these cattle that are going to get marketed in January. They're kind of being put on feed right now on the $4.50 range. So long and short of it, beef continues to look good in California. Supplies remain tight, and kind of expect things to be pretty good for quite a while. So beef continues to be strong across the United States as well as California. Let's start talking about crops here in California. Growing conditions were really great until probably early part of this week when some of the stuff from Hurricane Hillary came in and just provided some extra moisture, a lot of wind, especially down south. So I'm wondering how these guys are being affected on the corn side with silage and possibly also on the tomatoes in the south market if they got too much moisture dropped on them, especially since the fact that they're kind of becoming ripe and really subject to mildew and mold issues as this harvest starts underway. We should be getting into harvesting these tomatoes in the next week or two in our market. Prices, of course, because the contract basis remain good at $138 per ton, plus your seasonal bonuses, which puts you in the $150 to $155 a ton range when you get up north with his late season stuff. Crop size up till now looked really good, and actually got some pushback from some of the processors saying, hey, we're kind of worried about how many tons per acre we're going to take from you. Your contract states you at kind of a flat 60 tons per acre max. Anything over that, we'll renegotiate after the fact at some kind of market price. We'll have to see if they're right in that concern, but some of these fields look really good. So tomatoes look, hopefully if I get any rain damage, looks pretty good going forward. Hay market's just really tight. Not a lot of demand coming off these dairies. They're not bunking up supplies like they normally do. Cereal hays have really been hurt. They're in the $90 to $120 range for grass and wheat and oat hays. Just sitting out there in the field waiting for the rains to come, so there's a lot of stress to get them sold and off to somebody, so the prices come down quite a bit. Test hays off below that $300 mark, finally in the $285, $290 range, depending on who you talk to. And then dry cow hays, just again, sub $200, looking for a home. So I think the hay markets are kind of been depressed. Again, they're not so much demand because of this dairy thing, so we'll have to see how that kind of resets the market as we get in there. And also, there hasn't been a lot of test hays. I'm surprised that test hays come off as much as it has, given the lack of supply of it. But I think a lot of guys are figuring out ways to get around feeding that, especially with hulls being as cheap as they are in the market. Stone fruits, full swing. It's in a little bit of strength in those. Nectarines kind of in the $29 to $31 range. Watermelons picked up a little bit ahead of this kind of holiday season we're coming up to for September at the $175 to $203, depending on how many you can fit into a 24-inch bin. Nectarines have been following the same thing, and then we're kind of in this fresh grape market. We're pulling off out in the Kern counties, the Fresno County areas, going into fresh grapes. They're looking at $17 to $26 for every 19-pound bag of grapes coming off the fields, depending on what variety they are. Seems to be a decent price for the folks this year. Cotton's still holding at 84 cents. It's off about 5 cents. not as much moisture back east as you expect. Still quite a bit off of last year, which was in the 120 range. Guys back east should be able to make money at that. Out here, probably not as much. You haven't seen the planting here that you normally would, as you would in prior years. And the strawberries kind of coming off their seasonal highs, $11 for conventional, $15 for organic. We're still about 13 to 15% shy of last year's production year over year. Again, acreage has been kind of affected by the weather last year, and you're going to kind of see a continual pressure on the pricing as stuff comes in from south of the border and from north of our border from the Washington areas to kind of fill that need for the season. Long and short of it, I think crops look pretty well unless you got some rain damage in the past week. I think input costs next year are going to be interesting. Looking at a lot of stress on these input companies, Bayer, Conservis, really showing some subpar results versus last year as guys are just looking to pull back on some of the input costs they put into these crops in prior years. So we'll have to see how that all shakes out. But in long and short of it, weather's good, crops look decent, and we've got plenty of water. So that's an overview of what's going on with crops here in the valley. Let's talk nuts. Almond prices pushed up a little bit. They have been falling quite a bit after that objective report came out. They're up about 5 to 10 cents a pound across the board. It's kind of interesting to see how that's kind of fluctuated back and forth. An increase comes kind of out this fall, the pistachio prices. I think there's this kind of law of one price people are playing with, where pistachio prices had stayed relatively high, almond prices really low, and the folks are looking at that as a substitute basis and saying, hey, why don't I buy this other nut and bring in the pistachio down? But now I think you've kind of gotten to the point where the substitution's been reached, and we'll have to see what happens there. But almonds came up a little bit, still not looking really good in the $1.60, $1.65, $1.55, depending who you're talking to, range on a blend basis for this 23 crop. As guys come into the harvest season here in the next 3 weeks and finish out. So unless we get some kind of surprise in these numbers as they're coming off, and there's some early reporting as far as yields go, I think that's kind of the price we're going to get this year, unless we kind of get the final estimate that comes through in December when we see things there. Walnuts continue to kind of hurt. They were kind of on a push upwards, about 20 cents from last year's prices, and that's stalled and come off a little bit this week. Not much interest in those nuts, especially when everybody's kind of holding their breath waiting to see what these crop results are going to be. Huge big crop in China, continue to have a big carryover here. Input costs, guys are really not farming these trees as much as they normally would, so you wonder if they're going to really get that crop off that we're talking about. That remains to be seen. And there's also just a lot of flooding in China right now in the agricultural region. I personally wonder how that's going to affect the walnut trees over there. If they're going to get a harvest, is it going to damage them, causing them to pull out? And things like that, because it's a major export market for us, and they're so close to India compared to us. But the walnut thing just continues to look dire, and it makes me question a lot, like, do you keep those trees in, or you just pull the plug, take your losses, and kind of swap over? A lot of stress in the nut markets this year because of these things financially. If I was a bank, I'd be looking at these things and saying, hey, I've got 2 to 3 years of losses behind me between the almonds and the walnuts. Pistachios, maybe not so much. But it's got to be bleeding guys' working capital and their ability to kind of finance the next year's crop. And what I'd be looking for as a grower, if I've got 2 or 3 years of losses behind me, I'd really want to talk to my bank and say, hey, am I looking at getting a non-renewal notice of some kind from you next year where I can't get a crop line for the 24 crop? And if that is going to happen, what can I do to get my line in place? You want to be early on that, because if you're waiting for everybody else to kind of be in the same boat, it's going to be everybody at the same door trying to get through at the same time with these banks, and there's just limited capacity to handle deals like that, right? So these banks are going to ask for refinance of equity or sale of property to kind of inject into a company to maintain the margin that we need to have. So you're required to bring in cash to cover some of your crop, 20% per se. And if you don't have that, you're going to have to come up with it, and that's really where guys are going to go to the mattresses. It's going to be the real estate. Problem I have with that is back when you probably financed that real estate last time, it was 4%. Now you're looking at 8% per acre. It's a doubling of interest costs across the board if you want to do that. And so we'll have to see just how much of that's going on toward the end of the season. But I kind of see a little bit of a major banking pinch, especially with these kind of tighter banking regulations kind of coming off as multiple years of crop losses or crop tightness, and then just wondering how well people's balance sheets have kind of stood up to all that. So we'll have to see where that all ends up. That's the continuing saga of nuts here in California and what they're suffering through. Let's talk about interest rates. Bond markets stay pretty flat on the short side, really haven't moved up to the 5.4% for 1-month T-bills. It's the 10-year, 20-year, and 30-year mark that's kind of moved up. They moved up a good quarter point this past week. I think that's signaling to the market that, hey, we think the interest rates are going to be higher for longer because this inflation thing is much more sticky than people expected. We had a little pop-up in July that nobody's expecting, and inflation that had been month by month kind of declining or slowing down. And that's conversely turned into higher mortgage rates, which are up about, 0.15 to 0.2% on the longer term, 15 or 30-year mortgages, you're really creeping up toward getting an average rate of 8%. And I really think that's going to start just killing the housing market a little bit as far as people's ability to buy. If you really look at the amount of folks out there, the amount of inflation they've experienced, and then you throw on top of that the housing costs on the interest side, they're double what they were prior with the same housing value. I just don't see how that holds up, even with short inventories for quite a while. So you kind of got this stalemate happening between buyers and sellers. Buyers wanting to buy but not being able to qualify, sellers wanting to sell but not willing to bring down their price, and not willing to trade into a house at double the interest that they were at before without having that high price to compensate them for it. So you're kind of stuck in this weird market. That's even pushing up the jumbo loans. Jumbos were kind of in a cheap market for quite a while, but now they're in the 6.85% range. They're up a good 0.25 to 0.4% this week. Markets usually had looked at those loans as higher quality because they're usually higher equity people, and that folks have a bigger net worth. And that's kind of being trounced around a little bit because the cost of money to put those loans together is the same, so those rates are pushing up. Farm rates, man, you're looking at 30-year mortgages with a high of the 8.5 to 8.75% range, which is 2.5 times what they were a couple of years ago. And I really don't see how guys can refinance or purchase at that kind of a rate at a full loan to value basis and make sense of the crop. If you look at these pistachio crops, for example, back in a couple of years ago, you could finance a pistachio crop at $1,500 per acre, $1,200 per acre interest costs. Now you're looking at that same cost being in the $35,000 to $4,000 per acre range, which is almost as much as it costs to farm the property. So I think it's really going to kind of stagnate the movement of properties as well, unless people are coming in with cash purchases or are looking at properties that have very large amounts of equity they can access and with very little debt, especially these commodity prices like they are. So in the long range, I think you're going to see rates continue to be sticky, if not move up again 1 or 2 more times, because this inflation has been so sticky. I think that's going to really push back onto real estate a little bit, maybe just stagnate it for a while. If not, it should be signaling kind of a downward pressure on pricing, both in the housing market and the ag real estate market as well. But I just haven't seen that. So as an economist, it's kind of perplexing. And that's all I've got for interest rates. Thanks for listening. Got some additional thoughts of the week on there for what's going on in the economy and that I kind of worry about. Take a listen and see if it's something you want to hear more of, and we can keep doing that. Thanks.